Okay, let's look at Chapter 4, Completing the Accounting Cycle. Completing the accounting cycle means, you know what happens? Every year after 12 months, we start fresh. It's sort of like a etch-a-sketch in a way. You know, the little, I draw the little stick people with one of those, if you know what I'm talking about. And how do you start fresh? Well, you turn it upside down and you shake it. You're going to see in this chapter that we do something along those lines. What we start out with is worksheets. Now, worksheets aren't as used as much as they used to because now computers on just about everything. But back in the good old days, we looked at a worksheet with these labels listing the accounts, unadjusted trial balance. You recognize that number, both of these numbers. I'm showing you just the top portion of it. What you do is you list all the accounts, the unadjusted trial balance, then the adjustments that we made, those very adjustments in Chapter 3 that we made, all of those are shown here. For example, here was the prepaid insurance asset account, and we credited that account as part of one of our adjustments and reduced the account balance down to 1100. So you just work across here, adjusted trial balance, all the numbers, debits and credits for every account, and then at that point, from this point over, now you just move everything into one of these columns. Either it's an income statement account or a balance sheet account. Well, everything we're shown here are all assets, so they show up on the balance sheet. But if we were to continue on down, we'd get down to the revenue and expense accounts, and then those numbers, those would be shown in the income statement columns. Okay, let's see. Not used extensively, so we're going to end our discussion here, but we know their purpose and we know what they look like when they're used. On to page 12. A year has gone by. Remember the tax return service we started? We started it in July of 2018, and here it is. Amazing, isn't it? Already June 30th of 2019. A year has gone by. We've made all the adjustments we need to as of June 30th, 2019, the end of that first fiscal year. We don't know all the details about how we got these balances. It's 12 months worth of activity, but we know it's an adjusted trial balance, so all of the adjustments have been made. We don't need to make any more adjustments. So what we'll do is we'll use those balances to prepare the year-end financial statements. As we learned in Chapter 1, the income statement comes first. This is for 12 months. Service revenue, go up above. You see the balance up there? Well, let's take a look at it. There it is. And the expense accounts are all reported. Notice I've got them listed, largest down to the smallest, money-wise. Some businesses will use that system. Others might put them alphabetically. Doesn't really matter. Truth is, get them all in there. Those are all the expenses. We got those from the adjusted trial balance numbers right here. We prepare an income statement. We didn't know what net income was until we did this income statement. Now we see it's $30,800 net income for the 12 months ended June the 30th. The next financial statement, as you know from Chapter 1, is a statement of retained earnings for the same period of time, 12 months. Brand new company started with zero. There's the net income from the previous page. But look at the adjusted trial balance. Do we have a dividends paid? We sure do, $10,000. So we've got an end of the year balance in retained earnings. The unclassified balance sheet, which is the one that we learned in chapter 1, here it is. Now this is not centered like it should be here, but it's for a particular point in time. It's not for the year of or for the 12 months it is as of midnight, June the 30th, at the end of the year. Here are the assets that the company owns. Look, this is the book value of the furniture, the cost minus the accumulated depreciation, book value. All the liability accounts. Here, let's see. Oh, there's the net income. Net income here, balance retained earnings. Okay, here it is in the statement of retained earnings, 20,800. Add them together. Liabilities, stockholders' equity, 52,800. Add them together. Okay. The assets, okay, our balance sheet balances. Now, we're going to look at the balance sheet a little bit differently here. It's called a classified balance sheet. Classified balance sheet. Put like kinds of things together. Short-term assets are called current assets. Long-term assets, plant assets. We do the same thing with liabilities, short-term and long-term. Here's our listing categories. These accounts are what's called current assets. These are plant assets. Current liabilities, anything due 1 year or less than a year. All of these are liabilities. There's the funny looking one, unearned revenue. Recall from chapter 3, if someone pays this in advance, it's a liability, unearned revenue. And in this case, we just have one notes payable. There's some difference with international accounting standards here, and we'll be looking at some additional assets later on. So let's look at the new classified balance sheet. Same assets are listed, same liabilities listed. Everything's the same except the format of the report. Notice those current assets are listed together and totaled up. The plant assets together, then they're added together, the current assets, and in this case the plant assets, which are long-term assets, total assets. Liabilities, same classification. Short-term, current liabilities, and the long-term liabilities. Stockholders' equity is really unchanged. Now, what happens is, and bankers use this a lot, bankers look at, well, what are your current assets? How much do you have in cash and will get turned into cash real fast? How about your collections of accounts receivable and things like that? They look at that, and then they look at, oh, how much liabilities, how much debt is coming due soon that this business is going to have to pay for. And of course, they do some analysis, they do some calculations. In this case, got a high current ratio. Okay, got plenty of current assets to pay those current liabilities. No problem. Think about it. What if the business only had $3,900 worth of current assets, but had over $30,000 worth of current liabilities coming due very soon? The banker would look at that and go, uh-oh, problem. Okay, now we move in to that Etch-a-Sketch example I mentioned earlier. We close the books. After a year, after we've done the year-end financial statements, We've presented our income statement, statement of retained earnings, the balance sheet. Everything is done. Then we close the books. Closing the books means that we zero out certain accounts. For example, revenue. Revenue's got a certain balance. In our case on this page, $20,700. Okay. And we want to start a new year fresh. Remember, every 12 months we close the books. So we're going to zero out every revenue account. To zero them out, well, let's see. What kind of a balance does the revenue accounts have? Well, just a reminder, you know this, but it's got a credit balance. How are we going to possibly zero out that account balance? We don't just erase it or something. We have to make a journal entry to zero it out. To zero out a credit balance account, I'm going to have to debit that account. Next, we'll zero out all of the expense accounts, every one of them. Let's see. Well, these are all the expense accounts right here. We're going to have to zero all of those out as well. You're going to see that we've got this account called Income Summary. Income Summary. An income summary, it's just sort of a clearinghouse, really. And you'll see as we work through this, we'll debit it and then we'll credit it. And by the end of the day, Income Summary will have a zero balance. We only use this account once a year to help us zero out those accounts. The last closing entry we'll make is we'll zero out the dividends account. So let's take a look. Here's our year-end numbers. These are the numbers we use to prepare the year-end financial statements. Now we're going to zero them out to reset them. Keep page 15 handy. So the first one, zero out. To close the revenue account, zero it out. Debit service revenue for the $115,400 to zero it out. And the offsetting entry, the credit is to Income Summary, credit. C1, closing entry 1. C2, zero out every one of the expense accounts. You see them on the previous page. They all have a debit balance. Credit each and every one of those expense accounts, not just one big lump. You have to go each and every account, credit it to zero it out, total them all up. Total them all up. You could go over and look at the income statement if you wanted to, and where we've got them totaled up already. But you'll see, you total them up, and you debit Income Summary for $84,600. You zero out the expense accounts. Now, you look over here. Probably the trickiest one, I'll just use a T account. This account called Income Summary. What we do with income, our goal for the third account is to zero out the Income Summary account and move the balance over to retained earnings. Remember, net income makes retained earnings go up. So here's what we do on the first one. What did we do up here at the top of this page? Income Summary, we credited it $115,400. That was C1, top of this page. Okay. Now, here we've just debited the account for $84,600. Now the question is, there is no amount that we can put over here, credit income summary to zero it out. Debits have to equal credits to bring the account balance to zero. So the question is, we've got to debit this account for whatever amount we need to so that this account balance will go to zero. And when you punch that in the calculator and you notice, sure enough, it is the same as the net income because it's the difference between the revenue and the expenses here. We debit that account $30,800. That's this one right here. The reason this entry is $30,800 is because that's the amount that income summary needs to be debited to zero that account out. The last one, zero out the dividends. Dividends, credit the dividends account. It has a debit balance, so credit it to zero it out, and debit retained earnings. Now we've got two entries to retained earnings here. So make a note of this. Things could flip-flop if the company lost money a particular year. So we'll go over and look at the T accounts, but I'm gonna start with taking a look right here. You see these retained earnings, debits and credits right here. Let's go over to the T accounts page. Okay, let's see. Here's the income summary that I penciled in for you on the previous page. Okay, now let's see. Oh, here's retained earnings right here. Here is the closing entry 3, credit to retained earnings, debit to retained earnings when we closed out the dividends. Okay, account balance. So our activity, most of our activity is happening right here, what we call the temporary accounts. These are the accounts we want to zero out. Every one of them better be zero or there's a problem. Service revenue, zero. Rent expense, zero. Zero, zero. Each one of these accounts, including income summary, has been zeroed out. After posting those closing entries to the T accounts, changing the account balances, post-closing, after making the closing entries, what are the account balances? Check them. Check them. You know what better not be here on any post-closing trial balance? Better not be any revenue account balances. They've been zeroed out. If an account has a zero balance, it doesn't appear. Better not be any expense accounts up here now at the end of the year. Retained earnings, that account balance was changed. Look at the T account. It went up with net income, but down with the dividend. These balances, now that we have the post-closing trial balance, this is the balance, starting balance for the next year. We've reset revenues back to zero. We've reset expenses back to zero. We reset dividends back to zero. And now they will grow again for another 12 months. And then we'll do the same thing next year. We'll reset them again. These accounts will be the starting account balances for the new year. All of these assets, liabilities, and stockholders' equity accounts.